Well, let's start off with the US. I mean, we saw mixed results on the data front last week. The consumer confidence index leaping to its highest level in 18 months, but then home sales figures and durable goods disappointing. Is the market reaction we've seen to the data warranted in your books?
Hi, Alishia. I think so. If one just isolates the equity market for a moment, it's run up quite strongly since sort of mid-March this year. And, that was on the back of these massive stimulus packages. And that did create a lot of confidence in certain sectors. The problem being that the real global economy, as we've alluded to in the past, is still suffering, from a lack of confidence. And that's not leading, that's leading to further job losses. And as a result, the view is that potentially the equity market has run up too far. The risk appetite that has been evident in the market is a little bit excessive, and it's time for some consolidation, if not a correction.
Of course, the figures bring to question the strength of the recovery in the US and a dampening of risk appetite. But longer term, I mean, many have been saying that the dollar could well resume its slide. So what's your view moving forward on that front?
Yeah, Alishia, I remain an eternal dollar bear. The problem being here that the authorities, the monetary authorities globally, are trying to stave off this asset price deflation destructiveness that will happen should deflation set in, asset price deflation. That's been the objective. And, looking forward now, the market will continue to focus on that. And as we see more and more numbers coming out that are not showing that inflation is a threat, so the deflationary environment will become a stronger viewpoint in the market, and that will have an impact as far as equities and currencies and commodities are concerned. So the market really focusing on where asset prices are going. And then, of course, we've got some geopolitical tension in the world as well, just throwing a further spanner in the works.
Well, of course, it's in this entire context that the dollar has been marred by comments made by the president of the World Bank warning that the US should not take for granted the dollar's place as the world's predominant reserve currency. He alludes to other options being available in future. Do you see it playing a different role, and what are some of the options we're open to here?
Well, I certainly think that the question marks around the dollar's status as the world's only reserve currency will remain in vogue and will remain in the spotlight. As to how the monetary system changes globally, well, the devil is in the detail. Potentially we could have a basket of currencies or a basket of currencies and commodities that make up that mix. So it's going to take a very long time for global authorities to figure out how to fix part of this problem, because, of course, reliance on the dollar as the world's only reserve currency arguably is part of the reason that we find ourselves in the crisis that we are. The US has borrowed way beyond their means. They've been funded by central bank purchases of dollars and central bank purchases of US Treasury bills, and the parties carried on for a very long time, and clearly that's not sustainable for the immediate future.
Well, there's certainly a lot riding on US jobs later this week. Are you expecting a more subdued recovery to set the tone for the next slump here, or are you a bit more optimistic?
Yeah, I think the current tone will kind of remain in place, sort of 250 to 300,000 jobs a month loss in the US. And of course, that's not the complete picture, because just to remain even on the unemployment front, the US needs to create around about 200 to 250,000 jobs just to maintain sort of level unemployment levels. So, should we see a benign number, or, a so-called benign number in that region, or in fact a weaker number, that will call into question this whole notion of a recovery, because at the moment it really has been a jobless recovery as such.
Of course, when it comes to the recent rand strength we've seen over the most recent past, the dollar has been an incredibly big factor, but the other has been commodity prices and the strength we've seen filter through there. But if we look at gold, for example, it's fallen back to about $990 an ounce, and some are very disappointed by the inability of this price to stay above the 1,000 mark. So what's your view on that, that support that's been derived from that front moving forward?
Alishia, of interest to me, we've got all this Middle Eastern tension at the moment with Iran testing missiles, and and the discovery of nuclear sites in Iran, recent nuclear production sites in Iran, I would have expected oil, to gain some buoyancy on the back of that. And the fact that oil hasn't rallied really tells me a little bit about the positioning in the market as far as commodities are concerned. So I in fact expect a little bit further correction as far as commodity prices in general, and it wouldn't surprise me to see gold a little bit softer in the coming sessions, simply I think because the entire market is positioned the same way.
And then the second factor is the MTN deal. I mean, are you anticipating from what's emerged so far that things are going to run smoothly on Wednesday?
Well, it wouldn't surprise me. I know they've said that they're definitely not going to extend those talks. I think there's a general desire, a strong desire on both sides to get the deal done. So failing, any sort of substantial agreement before the deadline runs out, I wouldn't be surprised to see an extension of that deadline. For me, I think both MTN and Bharti wish to see the deal done. I think generally accepted the authorities wouldn't mind seeing the deal done because it would help some in the FDI department. But how do you get around the regulations? Because notoriously, when the regulators start playing around, that adds to the red tape and certainly could certainly delay the process. But I do see the deal ultimately going ahead.